Hello, my name is Andrew Milligan. I'm Head of Global Strategy here at Standard Life Investments. We've just finished our quarterly Global Investment Group meeting, our Asset Allocation Committee, so it's a perfect time to discuss with you our look ahead for 2016. Jeremy Lawson and I will be talking about some of the key drivers that we're going to be expecting over this period of time, not just the economics but also the politics, and in particular how we look at the profit cycle. Now, summing it all up in one simple sentence, yes, we are still having exposure to risk assets at this point of the cycle, by which I mean equities and corporate bonds and also real estate. But there are some concerns out there, and certainly we are reducing our levels of risk compared with earlier in the year. Let me introduce Jeremy, and he can talk to you a little about how we see the US monetary cycle and how important that's going to be for the outlook for financial markets into 2016.
It's becoming increasingly clear that the Federal Reserve is about to commence a policy normalisation cycle after many years of interest rates being sort of held at the zero lower bound. The important question for 2016, though, is not whether the Fed increases interest rates, it's how much. And there are a few things that will determine how much they are able to raise rates by. One's the global economy. We've seen global growth very subdued in recent years, partly because emerging markets in China have been decelerating. So if growth remains very weak in China, even worsens in 2016, that will inhibit the ability of the Fed to increase interest rates, particularly as that's transmitted through the US dollar. Second will be how domestic inflation pressures evolve. We've seen underlying inflation remain very weak through this cycle. Next year, headline inflation will rise as the baseline effects from lower commodity prices wash out of the numbers, but it's less clear whether underlying or core inflation will pick up much. There, the key will be the interaction between wage growth and productivity. We are seeing some improvement or some increase in labour cost pressures coming through the numbers, but if productivity growth also picks up from very low levels, then we're likely to see only a gentle increase in underlying inflation, which will enable the Fed to withdraw policy accommodation fairly slowly. The biggest problem for markets would be if the Fed has to move more aggressively because labour costs increase quickly and we don't see any rebound in productivity growth. That would suggest that the Fed was behind this curve. You'd see sort of bond yields rise much more quickly, and then that could be more of a threat to sort of broader risk assets as well.
Well, our concerns are that the global profits outlook is not that superb for 2016. As Jeremy has just described, there's a number of moving factors here related to the slowdown in China, the outlook for the US dollar, the extent of the rise in US interest rates. But simply at this stage of the cycle, with wage costs beginning to pick up, many companies, particularly in America, are finding it a little more difficult to drive profits growth forwards. The good news is that there are still companies in other parts of the world, especially Europe and Japan. And indeed, we might see some recovery, of course, if commodity prices pick up, even in companies in the emerging markets in the UK. But this is not a great backdrop at this phase of the investment cycle for profits to move ahead sharply. So all in all, 2016 looks to be a year for some nimble decision making. We might have to move assets quite sharply, as some of these factors, such as the extent of the increase in US interest rates or the extent of the slowdown in China, ripple through. But at this point at the start of the year, we're still generally overweight risk assets, by which I mean equities and corporate bonds. So we like investment grade, we particularly like European equities, and to a certain extent Japanese equities as well. Other equity markets, though, we're either neutral or underweight on. Within the government bond markets, bearing in mind what Jeremy has said about higher US interest rates, we are in a light or underweight position on most of the government bond markets around the world. The one exception, though, is Europe, where with ECB quantitative easing supporting that market, we still see a favourable outlook for European bonds. Generally, with interest rates moving in the ways that we've described, we're still in favour of the US dollar versus, for example, the euro or the yen. And we still like commercial real estate. As long as the economic recovery continues, and we do expect that in most countries around the world, despite relatively muted profits growth, then all in all, we think this is a favourable stage for the commercial real estate cycle.